So we expect absolute unbroken certainty when we flip a light switch.
Oh, totally. We demand it.
Yeah, the physical action is just binary, up or down, and we demand the result to be like instantaneous. The filament glows, the LED illuminates, the room brightens. The modern world basically relies on this invisible miracle operating flawlessly in the background. It allows us to just completely ignore the staggering complexity required to deliver that specific electron to that specific fixture at that exact millisecond.
Well, the thing is, that invisible miracle is sustained by an incredibly fragile equilibrium. I mean, you're looking at the culmination of physical infrastructure spanning thousands of miles. It's interacting with volatile commodities markets governed by centuries-old property laws, and this is key financed by global capital markets.
Right.
When you actually lift the hood on how that electricity is generated, transported, and ultimately monetized, the illusion of simplicity just vanishes entirely.
It completely vanishes. Which brings us to the core mission of our deep dive today. We're taking a dense, jargon-filled corporate earnings call, specifically the Eversource Energy, ticker symbol ES, Q2 2026 call, and we are just tearing it down to its studs.
I love it.
We're moving past the dry spreadsheets and the accounting acronyms to uncover a really high-stakes narrative about the physical reality of the grid. We are talking multi-billion-dollar offshore wind entanglements, brutal federal regulatory battles, surging energy demands, and how all of this friction ultimately dictates the exact number you are forced to pay on your monthly utility bill.
Because analyzing a regulated utility right now is essentially looking through a window into the future of our entire physical infrastructure. By understanding the intense friction between Wall Street's demand for returns, government regulators' demand for low prices, and just Mother Nature's relentless assault on the grid, you gain a massive edge in understanding exactly where the broader economy is headed.
Exactly. And look, we have a mountain of information from the Eversource executive team, including CEO Joe Nolan and CFO John Morera. They laid out the financial state of the business. But interpreting an earnings report like this requires a specific framework, doesn't it?
It does. Reading a utility's quarterly earnings is a bit like stepping on a bathroom scale while wearing a heavily weighted backpack.
Okay, I like that analogy.
Yeah, you have to actively separate your actual body weight from the temporary baggage you're carrying to get any real actionable picture of your baseline health.
And when Wall Street analysts tear into a company's financials, they initially encounter those GAAP earnings.
Right. GAAP stands for Generally Accepted Accounting Principles. It's the rigid, standardized legal framework for counting every single penny that flowed in and out of the enterprise during that 3-month period.
The official legal tally?
Exactly. It includes the core business operations, but it also includes the one-time events, the anomalies, the massive legal settlements or, asset sales. It forces the company to weigh themselves while holding that heavy backpack.
And the headline GAAP number for Eversource in the second quarter of 2026 was just 14 cents per share.
Which is rough.
It's brutal. Place that 14 cents next to the second quarter of 2025, where the GAAP number was 96 cents per share. I mean, on paper, without any context, a drop from 96 cents to 14 cents looks like an enterprise in absolute freefall.
Oh, 100%. And investors who trade solely on headline GAAP numbers often get burned precisely for that reason. Analysts are paid to strip away the noise and calculate the non-GAAP or recurring earnings. They mathematically remove the backpack to isolate the underlying operational engine.
Okay, so when you perform that extraction for Eversource, what's the actual weight?
Their recurring earnings for the quarter were actually 87 cents per share.
Okay. So 87 cents recurring compared to 96 cents the previous year. That's still a drop, but it completely recontextualizes the severity. The operational core of the business took a hit, but it's not collapsing.
Right. But as an investor, you need to isolate the specific operational drivers, forcing that recurring core number down from 96 cents to 87.
Where did they lose ground?
The erosion was primarily driven by lower earnings in their electric transmission segment. And as we'll explore extensively later, this specific loss is tied directly to a forced rate reduction engineered by federal regulators at FERC.
The federal chokehold.
Exactly. They also experienced lower earnings in their gas distribution business. Now, these losses were partially offset by higher electric distribution revenues, which indicates they collected slightly more capital, actually delivering power to end users across their local networks. Meanwhile, the parent company and other segment results remained essentially flat.
So the underlying machine is still functioning, albeit with slightly compressed margins.
Yep.
Let's redirect our focus to the backpack itself then. The financial baggage that violently dragged the GAAP earnings down to that ugly 14-cent mark consists of two massive financial charges. And looking at these, both charges reveal a company aggressively, almost painfully, attempting to permanently alter its corporate identity.
Yeah, they are undergoing a massive shift. The first piece of heavy baggage is the formal sale of the Aquarion Water Company.
Right. Eversource sold this water utility, and that generated $1.7 billion in net cash proceeds, which is huge. A $1.7 billion liquidity injection is a massive deleveraging event. They immediately deployed that capital to displace debt at the parent company level, strengthening their foundational balance sheet.
But there's a catch.
Always a catch. The esoteric mechanics of corporate accounting dictate that completing this sale triggered a non-cash after-tax charge of $111.4 million. That single transaction erased roughly 30 cents per share from their GAAP earnings.
So you have to ask, what is the strategic logic behind absorbing a $111 million accounting hit to divest a functional, profitable water utility?
It seems counterintuitive.
It is, until you look at corporate focus. Eversource is systematically amputating non-core assets to achieve a highly specific designation. They want to be known as a pure-play regulated pipes and wires utility.
The pipes and wires.
Just that. The executive team determined that the water business just diverts capital and managerial attention. They've similarly determined that the power generation business carries asymmetric risk. Their thesis is that the most reliable, sustainable, and defensible long-term growth lies exclusively in building, hardening, and maintaining the physical delivery grid.
So the pressurized pipes for natural gas and the high voltage wires for electricity.
You got it.
Okay, shedding the water utility aligns perfectly with that pure play thesis. But the second major charge that dragged down their earnings introduces this massive contradiction.
Oh, this is the really messy one.
Yeah, they recorded a devastating $164 million after-tax charge, which equates to about 44 cents per share, related to an offshore wind project called Revolution Wind. The earnings transcript defines this as an increase in their estimated offshore wind contingent liability.
And this specific line item represents the most acute point of tension in Eversource's multi-year transition strategy.
Look, hold on. If the entire strategic holy grail of this executive team is to become a pure-play pipes and wires utility, and they just absorbed a massive accounting hit to ditch a water company to achieve that purity, why are they hemorrhaging $164 million in cash into the Atlantic Ocean for a wind generation project? I mean, exiting the generation game should mean exiting the generation game, right?
You would think so. But the contradiction is resolved by the legal reality of a contingent liability.
Ah, the fine print.
Always the fine print. Eversource aggressively sought to exit the offshore wind sector, successfully selling their equity stakes in these massive maritime generation projects. However, unloading a multi-billion-dollar hyper-complex infrastructure project currently under construction in the middle of the ocean is not as simple as handing over a deed.
The buyers want assurances.
Huge assurances. The buyers demanded guarantees. Eversource accepted contractual obligations to bring this specific project across the finish line to finalize the exit. They can't just abandon the construction site. They carry a contingent liability tethering them to the execution risks until those turbines are actually spinning.
Wow. So they are legally shackled to the project until it reaches completion. And executing heavy civil engineering in a marine environment just basically guarantees unforeseen cascading expenses.
Absolutely. And the earnings transcript provides granular detail on exactly how those expenses compounded. The project suffered two distinct stop work orders.
Which is bad enough on land.
Right. In terrestrial construction, a stop work order means heavy machinery sits idle in a dirt lot while lawyers argue. But in offshore wind construction, the logistical choreography is totally unforgiving. These projects rely on wind turbine installation vessels, or WTIVs.
WTIVs.
These are not standard cargo ships. They are highly specialized maritime behemoths equipped with massive jackup legs that literally plant themselves on the ocean floor, lifting the entire ship out of the water to create a stable platform.
That sounds insanely expensive to operate.
It is. They feature cranes capable of hoisting 14-megawatt turbine components. We're talking blades the length of football fields and nacelles the size of houses hundreds of feet into the air in open ocean conditions.
And because of the Jones Act, which heavily restricts foreign vessels from operating freely between U.S. ports, the global supply chain for these specific installation vessels operating in American waters is virtually non-existent, isn't it?
You hit the nail on the head. There is a severe global bottleneck for WTIVs. You have to reserve these vessels years in advance with staggering day rates. So when the stop work orders hit Revolution Wind, the installation vessel they had under contract couldn't just drop anchor and wait around.
It had somewhere else to be.
Exactly.
Yeah.
It was contractually obligated to move to the next project somewhere else on the globe. Eversource lost their specialized boat. When the regulatory hurdles were finally cleared and work could resume, they faced the agonizing reality of remobilization.
So they had to go to the back of the line.
And pay up. Finding a replacement vessel or negotiating the return of the original one outside of the contracted window requires paying massive premiums. The bulk of that $164 million charge stems directly from the cascading logistical nightmare of simply getting the requisite machinery back into the ocean to fulfill their legal obligation to walk away.
The financial bleeding is severe, but the physical reality on the water tells a slightly different story, doesn't it? CEO Joe Nolan explicitly highlighted that despite the missing vessels and the massive capital drain, Revolution Wind is actually roughly 97% complete.
Which is a huge milestone.
Yeah. The turbines are fundamentally operational. The project is currently delivering 300 megawatts of capacity directly into the ISO New England grid, and they are actively ramping up toward the full 704 megawatt capacity, targeting a commercial operation date later this year in 2026.
So the execution is succeeding even as the budget fails. This sequence encapsulates the brutal reality of their transition. Divesting Aquarion and absorbing the catastrophic cost overruns to finalize Revolution Wind demonstrates a leadership team willing to endure immense short-term financial pain to permanently simplify their corporate DNA.
They are burning the ships to ensure they solely operate the regional transmission and distribution grid.
That's the play.
But look, that strategy requires a fundamental belief that the simple business of operating transmission wires is actually a safe harbor. And the reality exposed in this earnings call is that running pipes and wires is currently caught in a suffocating federal regulatory chokehold.
It's not the safe harbor they hope for.
Right. Eversource can shed all the water and wind assets they want to simplify their business, but that simplicity is a mirage if they don't actually control the profit margins on the wires they have left. And that power sits in Washington, triggering an existential battle with FRC.
FERC, the Federal Energy Regulatory Commission. They dictate the economic viability of the entire interstate transmission system. To comprehend the stakes of this battle, we have to dissect the concept of ROE, or return on equity, because this single metric dictates the flow of trillions of dollars in capital.
Okay, let's unpack that for you guys listening. A utility like Eversource basically operates as a natural monopoly within its geographic footprint. Economic efficiency dictates that we cannot have 5 competing companies building 5 overlapping sets of high-voltage transmission lines through a single mountain pass. It would be chaos.
Complete chaos.
So, because the utility faces no market competition, they are shielded from normal capitalistic pressures. In exchange for this monopoly status, the government heavily regulates their pricing to protect the consumer from extortion.
Right. So the regulatory compact works like this. The utility determines that a specific region requires a new billion-dollar transmission corridor to prevent rolling blackouts. They petition the regulators. If the regulators agree the project is necessary, they grant the utility permission to build it. And crucially, permission to charge the captive ratepayer base to recover the exact cost of the project.
But recovering the cost isn't enough, is it?
No, it's not. The utility has to attract the initial $1 billion from global capital markets. We're talking pension funds, institutional investors, retail shareholders. To attract that capital, the regulators authorize a guaranteed profit margin on top of the recovered costs. That authorized profit margin is the return on equity.
And the regulators are constantly managing a razor-thin balancing act here. If FERC sets the ROE too low, the utility cannot offer a competitive yield to Wall Street. The institutional capital just flows elsewhere. The utility fails to raise the funds necessary to modernize the grid, and the physical infrastructure inevitably degrades, leading to catastrophic failures. Blackouts. But on the flip side, if FERC sets the ROE too high, the utility effortlessly attracts capital and generates massive profits. But the captive everyday consumer is financially crushed by exorbitant monthly bills.
Exactly. Historically, FRC has maintained utility ROEs in the 10% to 11% range, recognizing the massive capital requirements of the energy transition. However, in March of 2026, FERC issued a decision that fundamentally destabilized this entire compact.
This was the bombshell.
Huge bombshell. They unilaterally slashed Eversource's base transmission ROE down to 9.57%.
Wow.
And a drop below 10% sends a massive shockwave through the financing models of every single planned infrastructure project. But this is the crazy part. The rate reduction itself wasn't even the catalyst for the current uproar.
Right, it was the timing.
FERC took the unprecedented step of ordering this new suppressed rate to be applied retroactively, demanding a refund spanning more than a decade.
Wait, hold on. An infrastructure project requires budgeting over 20, 30, or 40-year horizons. How does a utility accurately model the financial viability of a multi-billion-dollar capital deployment if a federal agency can arbitrarily reach back a decade and claw back legally authorized revenues?
They can't.
It completely obliterates the concept of regulatory certainty.
It absolutely does. The retroactive nature of this ruling introduces a toxic element of unquantifiable risk into the utility sector. Think about it. If the rules governing historical profits can be rewritten unilaterally, the perceived risk of investing in regulated utilities skyrockets.
Which means investors demand more to play ball.
Exactly. Investors demand a higher risk premium to deploy their capital, which ironically increases the long-term cost of debt for the utility, ultimately driving up consumer prices down the line anyway. It creates a chilling effect exactly when the macroeconomy requires unprecedented investment to support electrification, EVs, data centers, all of it.
But Eversource didn't just roll over and accept the haircut, did they?
Definitely not.
They launched a highly aggressive, multi-pronged legal and regulatory counteroffensive against FRC to defend their balance sheet and the broader principle of regulatory certainty.
Right. So their first tactical move was basically defensive triage. They immediately petitioned FRC and secured an approval to delay the physical payment of any retroactive refunds until mid-2027.
Stop the bleeding.
Exactly. They successfully staved off the immediate liquidity drain, protecting their cash position while the actual legal battles play out.
And their second move attacks the foundational legality of FRC's decision. Eversource filed a formal petition for review and a motion for a stay with the D.C. Circuit Court of Appeals. And the legal arguments detailed in this earnings call are incredibly sharp. First, they argue that FRC explicitly exceeded its statutory authority under the Federal Power Act.
Because of the timeline.
Yeah, the legislation governing FRC dictates a strict 15-month maximum window for ordering refunds. By attempting to enforce a decade-long clawback, Eversource argues the agency is operating far outside the boundaries established by Congress.
And that 15-month statutory limit exists precisely to prevent the retroactive financial chaos we are discussing right now. The core of this issue stems from the glacial pace of administrative law. This specific rate case has been trapped in a labyrinth of appeals and remands for years.
Typical bureaucracy.
Basically.
Yeah.
An appellate court previously reviewed an earlier FERC decision on this matter and remanded it back to the agency for further review. FERC then just sat on the docket, delaying their final decision for nearly 10 years. So Eversource's second legal argument leverages this delay, stating that punishing a company retroactively for a decade of regulatory limbo created entirely by the agency's own inaction constitutes a fundamental denial of due process.
Yeah, you can't trap an enterprise in a bureaucratic holding pattern for 10 years and then penalize them for the duration of the delay. That's insane. And the third prong of their legal argument points out that FERC's newly mandated rate of 9.57% is logically indefensible because that exact specific rate was scrutinized in prior legal proceedings and explicitly found to be unjustly low.
So they're presenting the D.C. Circuit Court with a very compelling narrative of administrative overreach. They're saying the agency ignored statutory time limits, weaponized its own bureaucratic delays against the utility, and finalized a rate mathematically proven to be insufficient in prior hearings.
It's a strong case.
But they didn't stop there. Eversource paired this defensive legal strategy with a highly aggressive offensive maneuver. In April, they filed a Section 205 request with FERC.
Okay, a Section 205 filing is the formal mechanism a utility uses to request a new rate. So, while actively suing FERC over the 9.57% rate, Eversource officially requested a new base ROE rate of 11.39%.
Which is a bold move.
Very bold. But the brilliance of the 11.39% request lies in the methodology. Regulatory agencies rely on complex financial models, typically capital asset pricing models, or discounted cash flow models to calculate appropriate ROEs. These models utilize macroeconomic inputs, heavily weighting the risk-free rate, which is derived from U.S. Treasury yields. CFO John Morera noted that Eversource didn't invent some novel, aggressive mathematical formula to reach that 11.39%. They simply took ARCO's existing legally approved ROE methodology and just updated the inputs to reflect the current macroeconomic reality of 2026.
Which makes perfect sense because the economic environment has fundamentally shifted over the last 5 years.
Oh.
I mean, inflation spiked and the Federal Reserve aggressively hiked interest rates in response. If the risk-free rate of a U.S. Treasury bond jumps from 1% to 5%, the required return for a riskier equity investment in a utility must rise proportionally to attract capital.
Just basic math.
Exactly. Eversource is arguing that the math simply demands a higher ROE based on the current cost of money.
So how did FERC respond to that?
Well, FERC responded by exercising their statutory right to suspend the implementation of the newly requested 11.39% rate for the maximum 5-month period allowed by law.
Stalling again.
Buying time. This forces a period of paper hearings and settlement negotiations. However, that 5-month clock is ticking. The suspension expires, and a newly calculated rate is expected to legally go into effect on November 30, 2026.
Okay, so mark your calendars because November 30th represents a massive catalyst for the stock and the underlying business.
Huge catalyst.
But look, while Eversource deploys elite legal teams to battle the federal government over high-voltage interstate transmission margins, the tension is arguably even more severe at the hyperlocal level. In their home territory, they are forcing local residents to confront the staggering cost of modernizing an aging grid. And this friction between Wall Street expectations and consumer affordability perfectly crystallizes in the Connecticut rate case.
Oh, this is the exact intersection where abstract macroeconomic policy collides violently with the microeconomics of the household budget.
Let's get into it. Eversource operates in Connecticut through its subsidiary, Connecticut Light and Power, or CL&P. They recently filed a comprehensive rate review with state regulators, representing their first general base rate request since 2017.
A near-decade gap.
Which is wild. A near-decade gap between base rate cases is highly unusual in the modern utility sector, meaning the accumulated financial pressures have reached an absolute boiling point. The specific numbers requested are jarring. Eversource calculated a total revenue deficiency of $451 million.
$500 million, basically.
Yeah. And to plug that massive gap, they proposed a 10.25% ROE for their state-level distribution assets. Now, if the state regulators approve this request without modification, it triggers an 11% instantaneous increase on total customer bills across the state.
And you can imagine the immediate public reaction to an 11% spike on a utility bill is visceral outrage.
Of course it is.
Consumers have endured relentless inflation across housing, groceries, insurance. Adding a massive double-digit hike to a non-negotiable essential service naturally breeds intense skepticism. The primary assumption from the public and local politicians is that this $451 million deficiency is just the result of bloated corporate bureaucracy, excessive executive compensation, or operational inefficiency.
And as an investor, you have to ask, is it bloat? I mean, an 11% hike is brutal for the average consumer. Where is all that money actually going?
Well, CFO John Herrera directly anticipated this hostility during the earnings call. He aggressively deconstructed the $451 million deficiency to isolate exactly where the capital is flowing, actively attempting to dispel that narrative of corporate bloat. He pointed out a really crucial statistic. Only 11% of the entire requested revenue increase is earmarked for operations and maintenance, or O&M.
O&M, right, the day-to-day stuff.
Exactly. O&M encompasses the day-to-day operational friction of running the enterprise, the salaries of the workforce, the fuel for the fleet of bucket trucks, the software licenses, raw materials. Allocating only 11% of the increase to these categories over a 9-year period characterized by historic inflation is actually a testament to aggressive cost control.
The numbers back that up.
Yeah, Morera reinforced this by citing that Eversource systematically identified and executed deficiencies that allowed them to actively avoid $45 million in projected O&M expenses since 2017.
Okay, so if 89% of the $500 million ask isn't funding the daily operations or corporate overhead, where exactly is the capital actually going?
The vast majority of the request is strictly allocated to hard capital investments, systemic storm resiliency programs, the natural depreciation of newly installed physical assets, and unavoidable state and local tax obligations.
Physical upgrades.
Yes. The capital is flowing directly into the physical metal, wood, and silicon of the distribution grid. They're replacing degrading substations, installing thousands of miles of thicker, more resilient conductor wire, replacing rotting wooden utility poles with composite structures, and this is the big one, deploying advanced automation technology to harden the system against the increasingly violent weather patterns ravaging the Northeast.
Look, consumers demanding lower bills also demand uninterrupted power during a hurricane. You cannot have cheap, aging infrastructure that somehow survives a Category 3 storm. The executive team recognized that asking for 11% requires proving the return on investment to the ratepayer. And CEO Joe Nolan provided hard, verifiable statistics detailing exactly what the $4 billion already invested in the Connecticut grid since 2017 has physically achieved.
And those statistics illustrate a fundamental evolution in how the grid operates. Prior to these investments, the distribution system was largely passive. If a falling tree severed a line, the system simply failed. A physical crew had to patrol the line, identify the damage, and manually operate massive mechanical switches to isolate the fault.
Super labor-intensive.
Very. But the capital invested since 2017 deployed thousands of automated reclosers and digital relays, all communicating in real time via SCADA supervisor control and data acquisition systems.
So a modern recloser acts like a highly intelligent version of the circuit breaker in your basement. When a fault occurs, say a branch touches a wire and creates a massive short circuit, the digital sensors detect the severe voltage drop and current spike in milliseconds. The recloser instantly breaks the circuit, stopping the flow of electricity to prevent catastrophic damage or fire. But unlike your basement breaker, it automatically closes the circuit again a fraction of a second later to test if the fault was temporary, like a branch just falling past the wire rather than resting on it.
Exactly. And if the fault persists, the SCADA system analyzes the network topology and instantly sends digital commands to other automated switches throughout the neighborhood, dynamically rerouting power around the damaged section. Nolan revealed that nearly half of all power interruptions experienced by Connecticut customers in 2025 were resolved remotely via this automation in a matter of minutes.
Which entirely eliminates the need for a physical truck roll. The infrastructure is increasingly self-healing. This technological leap translates to tangible improvements for you, the ratepayer. The average Eversource customer in Connecticut now experiences just one outage roughly every 2 years, which represents a verified 15% improvement in systemic reliability since the 2017 baseline. Even more staggeringly, the system's ability to isolate faults and reroute power meant that over 1.5 million customer outages were completely avoided last year. The grid absorbed the damage, dynamically reconfigured itself, and the end user never even saw their lights flicker.
So the utility is basically arguing that the 11% rate increase is the price of admission for a fundamentally superior, hyper-resilient product. However, the modernization effort is far from complete. The rate case heavily features a massive, highly contentious proposal to implement advanced metering infrastructure, or AMI.
AMI smart meters.
Right, AMI represents the transition from dumb meters to smart meters. Legacy meters simply spin a dial tracking total consumption, requiring a human or a drive-by truck to collect the data once a month. AMI meters contain two-way cellular communication modules, transmitting granular minute-by-minute consumption data back to the utility while allowing the utility to interact with the meter remotely.
But deploying that network across Connecticut requires a staggering $1 billion in upfront capital investment, followed by $300 million in ongoing O&M expenses over the life cycle of the technology.
And the financial justification for a billion-dollar deployment hinges on a rigorous benefit cost analysis, or BCA. The AMI system theoretically provides massive economic benefits. It eliminates manual meter reading costs, enables time-of-use pricing to incentivize customers to shift energy usage away from expensive peak hours, and provides the utility with high-resolution data to optimize grid voltage and prevent transformer blowouts.
Sounds great on paper.
It does. But during the earnings call Q&A, an analyst pressed management on the economics of this specific BCA, and the executive team revealed a fascinating, deeply ironic detail.
This blew my mind when I read the transcript. They disclosed that the analysis shows a slightly positive nominal net benefit, meaning the total dollars saved eventually exceed the total dollars spent. However, when evaluated on a net present value, or NPV basis, the project technically turns negative.
Which is a huge problem. Net present value is the foundational concept of finance, heavily reliant on the time value of money. A dollar generated 10 years from now is intrinsically worth less than a dollar held today, primarily due to inflation and the opportunity cost of not investing that capital elsewhere. You apply a discount rate to future cash flows to determine their present value. If the NPV is negative, the project destroys economic value.
But the sheer irony is that the technology itself didn't fail the economic test. The NPV turned negative directly as a result of bureaucratic friction. The executive team explained that this specific regulatory docket to approve smart meters in Connecticut has been languishing in administrative limbo for years.
While the utility waited for the regulators to grant permission, the macroeconomic environment shifted violently. Inflation ravaged the supply chain. The cost of silicon, cellular modules, and specialized labor skyrocketed.
So the operational benefits of the smart meters remained mathematically constant, but the upfront capital costs required to purchase them inflated massively during the delay.
Exactly. The regulatory drag literally eroded the purchasing power of the utility, turning a mathematically beneficial project into a net negative for the very consumers the regulators are mandated to protect.
It is a devastating indictment of slow-moving bureaucracy in an inflationary environment. To salvage the economics of the deployment, Eversource is currently lobbying aggressively for an expedited approval this fall. They are executing a similar AMI rollout in neighboring Massachusetts and have locked in highly favorable contractual pricing with their hardware vendors based on the massive volume of that order.
So they want to piggyback on that order.
Exactly. If Connecticut regulators approve the docket immediately, Eversource can legally piggyback the Connecticut meter order onto the Massachusetts contract, leveraging economies of scale to artificially suppress the vendor costs and force the NTV back into positive territory.
The situation in Connecticut flawlessly encapsulates the central dilemma paralyzing modern utilities: how to balance the political mandate for affordable rates today against the physical imperative of building a reliable grid for tomorrow. This tension becomes explosive when theoretical rate models are violently stress-tested by the physical reality of extreme weather.
Which directs us to the most volatile, unpredictable segment of a utility's financial ledger: storm recovery costs. Eversource's territory in New England is subjected to a brutal, varied gauntlet of severe weather. You've got crippling winter blizzards, coastal nor'easters, and hurricane landfalls. When these events decimate the grid, the utility doesn't have the luxury of debating the budget. They must mobilize thousands of line workers, forestry crews, and logistics personnel to rebuild the infrastructure in a matter of days.
They have to act immediately.
Right. And recently, Eversource received their final storm cost recovery decision from PURA, Connecticut's Public Utilities Regulatory Authority.
Over the preceding years, Eversource documented and submitted $975 million in expenses directly related to emergency storm restoration. They petitioned PURA to recover this massive outlay from the rate base.
How did PURA rule?
PURA's final ruling was surgically detailed. Of the requested $975 million, the regulators explicitly approved the recovery of approximately $870 million, validating the vast majority of the emergency expenditures. They deferred roughly $60 million pending the completion of a highly granular third-party audit to verify specific invoices, and they permanently excluded about $40 million, deeming those specific costs imprudent or ineligible for recovery.
Okay, securing $870 million in approved recovery is a massive win for the balance sheet, but PURA's ruling included a punitive, highly contentious caveat. They outright denied Eversource the ability to recover any carrying charges associated with the storm response.
Which hurts, because to grasp the severity of this denial, you must understand the liquidity mechanics of a crisis. When a hurricane destroys the grid, Eversource does not have $900 million sitting dormant in a checking account waiting to be deployed.
They have to borrow it.
They must immediately source massive amounts of short-term liquidity, often utilizing commercial paper markets or drawing on revolving credit facilities to pay the army of mutual assistance crews working 24/7. They front the massive cash outlay immediately. It takes years for the regulatory bureaucracy to review the receipts and authorize the recovery. During those years, the utility is paying interest on the money they borrowed to restore the power.
And those interest payments are the carrying charges.
Exactly. PURA ruled that while the ratepayers must reimburse the utility for the physical wire and the hourly labor of the linemen, the utility shareholders must eat the entire cost of financing the emergency response.
Absorbing years of interest on nearly $1 billion of short-term debt is a bitter pill. But the utility still possesses an approved asset of $870 million. The logistical challenge now shifts to monetization, right? I mean, if Eversource simply applied an $870 million surcharge to Connecticut utility bills next quarter, the resulting rate shock would bankrupt vulnerable residents and trigger unprecedented political backlash. They need a mechanism to instantly replenish their corporate liquidity without instantaneously crushing the consumer.
And the mechanism they utilize is a highly specialized financial maneuver known as securitization.
Let's break that down.
Okay, instead of forcing the ratepayer to absorb a massive, immediate bill for past storm damage, Eversource collaborates with the state legislature to issue storm recovery bonds directly into the global financial markets.
Securitization essentially creates a financial shock absorber. The utility establishes a bankruptcy-remote special-purpose entity. The state legislature grants this entity the irrevocable legal right to levy a small, non-bypassable surcharge on every single utility bill in the state for the next 10 to 15 years. Because this surcharge is guaranteed by law, the bonds issued by the special-purpose entity receive a AAA credit rating, allowing them to be sold to institutional investors at incredibly low interest rates.
And the investors purchase the bonds, injecting hundreds of millions of dollars in upfront cash directly into Eversource's treasury today. This immediately deleverages the utility's balance sheet, allowing them to pay off the expensive short-term commercial paper they used during the storms. The investors are then slowly repaid over the next decade via that small, steady surcharge on the consumer's monthly bill.
It effectively operates like taking out a 15-year mortgage to pay for emergency roof repairs. The utility gets the cash to fix the roof immediately, and the homeowner pays it off in manageable monthly increments.
Great analogy. CFO John Morera provided a timeline for this liquidity event. The securitization process requires drafting the financial architecture, securing final regulatory approval for the bond structure, acquiring the credit ratings, and executing the roadshow to market the bonds to Wall Street. He anticipates this process will culminate in nearly $700 million in cash, flooding into Eversource's treasury from Connecticut roughly a year from now.
And they have another pot of money waiting too, right?
Yeah, they have an additional $450 million in storm costs currently moving through a similar securitization pipeline in New Hampshire.
Wow. Securing over $1 billion in guaranteed future cash flow radically de-risks their balance sheet. It provides the financial foundation necessary to pivot away from merely repairing the damage of the past and focus massive capital deployment on constructing the grid of the future. The earnings call highlighted a monumental victory regarding long-term infrastructure expansion.
ISO New England, the independent nonprofit organization responsible for managing the wholesale electricity market and ensuring the reliability of the bulk power system across the 6-state region, issued a highly competitive request for proposals in their 2025 longer-term transmission planning process.
They analyzed the macro grid and determined a critical need for a massive expansion in high voltage capacity. And Eversource, operating in a strategic joint venture with Avangrid, submitted a proposal that was officially selected as the preferred solution.
And this is not just a routine infrastructure upgrade. This is a $2.2 billion mega project designed to fundamentally re-architect the flow of power across the Northeast. Eversource's proportional share of this massive capital deployment is approximately $700 million.
That's massive.
The engineering objective is to drastically increase the transmission capacity corridor running from the northern reaches of Maine and New Hampshire down into the densely populated load centers of southern New England, targeting a commercial in-service date of 2032.
So the obvious question for you listening is, why is this specific geographical corridor so vital that the regional grid operator is willing to authorize over $2 billion of ratepayer capital to expand it? The answer lies in a massive structural bottleneck threatening the economic viability of the entire region.
The Northeast grid suffers from a severe geographic mismatch between generation and consumption. CEO Joe Nolan emphasized a staggering economic reality. 80% of a typical customer's monthly bill is entirely dictated by the raw commodity cost of the energy supply itself.
Because remember, Eversource operates the delivery pipes. They do not generate the power, and they do not earn a profit markup on the power they procure for their customers. They simply pass the wholesale cost through. The only mathematical way to significantly lower the ratepayer's bill is to flood the regional wholesale market with cheaper, abundant power.
Right. The cheapest, most abundant clean power available to New England, massive onshore wind farms and vast Canadian hydroelectric resources, is geographically stranded in the north. Yes. The existing transmission lines, acting as the arteries connecting the northern generation to the southern consumption hubs in Boston and Connecticut, are physically maxed out. They hit thermal constraints. You basically have a massive reservoir of cheap power trapped behind a tiny pipe. The $2.2 billion project builds a massive new pipe to relieve the pressure and lower wholesale costs for everyone.
But lowering supply costs is only half the equation, isn't it? The second, arguably more existential macro factor driving this massive investment is the impending wave of the artificial intelligence revolution.
Oh, this is the real driver.
Joe Nolan explicitly warned that if New England intends to capture the staggering economic growth associated with advanced data centers, expanding the bulk transmission capacity is an absolute non-negotiable prerequisite.
The physical reality of a modern AI data center is difficult to overstate. A single hyperscale facility can demand hundreds of megawatts of continuous, uninterrupted baseload power. They require 99.999% uptime.
And our grid wasn't built for that.
Not at all. The existing grid architecture was designed to handle the predictable ebb and flow of residential and traditional commercial demand. It is completely unequipped to handle the massive, concentrated, continuous power draw of millions of GPUs running complex large language models simultaneously.
If the transmission highways are not expanded immediately, the region faces a catastrophic scenario. The grid will hit physical constraints, the ISO will be forced to deny interconnection requests from tech companies, and the economic engine of the AI revolution will simply bypass New England entirely, migrating to regions with superior power infrastructure. Building this corridor is a defensive measure to prevent regional economic stagnation.
So you have to look at the whole picture.
Exactly. We have dissected a company engaged in a radical transformation. They are absorbing massive accounting charges to shed their water utilities. They are bleeding capital to finalize complex offshore wind construction so they can permanently exit the generation business. They are engaged in vicious, multi-year legal warfare in federal appellate courts to protect their transmission profit margins. They are fighting trench warfare against state regulators to recover hundreds of millions in storm damage, while simultaneously demanding $1 billion to deploy smart meters. And they are partnering on a $2 billion mega project to literally rewire the Northeast for the AI era.
It's exhausting just listening to it. The ultimate question for any investor or analyst reviewing this earnings call is whether this intense multi-front war is fundamentally destroying the financial health of the enterprise or forging a stronger one.
And the data dictates the latter. I'd argue this is a massive buy signal. Despite the horrific headline GAAP numbers, the core balance sheet is demonstrating remarkable resilience. Management highlighted their FFO to debt metrics.
FFO, funds from operations.
Right. It measures the actual cash generated by the core business, measured against the massive debt load required to build the infrastructure. At the close of the quarter, their FFO to debt ratio stood at a highly healthy 14.3% according to Standard & Poor's, and an even stronger 15.7% according to Moody's.
And in the highly leveraged utility sector, maintaining a robust FFO to debt ratio is paramount to survival. Both of those figures sit comfortably more than 100 basis points above the strict thresholds that would trigger a devastating credit rating downgrade.
Wall Street is signaling deep approval of the pure play strategy. Moody's recently upgraded Eversource's official credit outlook from negative to stable, signaling confidence that the turmoil of the asset sales and the wind project liabilities are finally in the rearview mirror.
Management's forward-looking guidance reflects supreme confidence in the pure play model, too. They officially reaffirmed a staggering $26.5 billion 5-year capital expenditure plan running through 2030. They intend to deploy $26.5 billion into the physical grid over the next 60 months.
That is just an astronomical amount of money.
It is. They projected needing between $800 million and $1.1 billion in new equity to fund this massive build-out. But crucially, they require zero new equity issuance in 2026.
So no immediate dilution for shareholders.
Right, relying entirely on internal cash flows, the Aquarion sale proceeds, and the impending securitization capital. They reaffirmed their 2026 earnings per share guidance of $4.57 to $4.72 and confidently predicted that their long-term growth rate will accelerate into the upper half of their 5% to 7% target range by 2028.
So the turbulence is subsiding. The strategic amputation of non-core assets, while painful in the short term, has positioned them to execute exclusively on the massive guaranteed capital requirements of modernizing the grid.
That's the bottom line.
And the crucial realization for you, navigating this deep dive, is recognizing the unavoidable macroeconomic reality hidden within these earnings transcripts. Whether you are an institutional investor modeling utility yields or a resident simply trying to budget for next month's electricity bill, the fundamental physics of the grid require unprecedented investment. hardening the infrastructure against the violent reality of climate change, and building the massive transmission highways required to feed the insatiable power demands of the AI revolution requires trillions of dollars globally.
Trillions. And ultimately, through complex rate cases or securitization charges, that staggering cost will inevitably materialize on your monthly bill. The era of cheap, invisible, taken-for-granted electricity is just ending.
The transition from legacy infrastructure to a hyper-connected, resilient grid is arguably the most capital-intensive engineering project in human history. The utility sector is at the absolute epicenter of this transformation. Eversource has successfully divested its generation assets, betting its entire corporate survival on the deceptively complex business of moving electrons from point A to point B. They are a pure-play pipes and wires utility now.
Completely all in.
But this transition forces us to confront a terrifying macroeconomic paradox. Think about this as we wrap up. If state and federal regulators continue to aggressively squeeze utility profit margins, delay essential smart grid approvals, and retroactively claw back earnings in the name of short-term consumer affordability, exactly as the AI revolution and the electrification of transportation demand exponential increases in physical grid capacity, will the physical grid break before the regulators blink? In this high-stakes standoff between the rigid bureaucracy of Washington, the relentless demands of Wall Street, and the surging physical requirements of the 21st century economy, who actually holds the ultimate leverage?
That is the multi-trillion-dollar question.
The next time you flip that binary switch and expect the room to instantly flood with light, consider the invisible war raging to keep that simple promise alive. Thank you for joining us on this deep dive.